So we get the question a lot, I'm confused at what to do. Do I buy or do I sell? So as much as I'd like to tell you, you can do either or you can do both. And although that is true, and I will actually come back to that in the very end of this, what I want to do is give you some tools to use so that no matter where price is at, you know exactly what to do and you never have to be confused about what to do. What's important to understand is that the market is fluid. What happens with most traders is they get caught up in being married, quote unquote, to a position. So either they are long or short and they have to be right. They have to win that trade. And when they're wrong, most traders tend to stay wrong. And then they keep fighting, and that carries over into the next trade, and then the next trade, and then the next trade, and then they blow up their account. This is completely unnecessary. There is absolutely no reason to do that, especially with the way that we're trading in the live trade room. So I want to cover a couple things here that should really help you understand a few things. And what I want to try to do is just give you clarity so that you never ever have to open up charts and wonder what you should be doing. Now, does this mean you're going to start winning every trade? No, of course not. But this should really cut down on any frustration or any confusion about what to do. So I want to talk about some basics. So this little clip here is really just an illustration that I put together that really shows three things. The first thing is that it shows typical market movement. You know, the market moves up and down and it kind of bounces along as the day goes on. The other thing it shows are accurate price levels. You can see it testing these. Obviously this is just an illustration, but you can see it bouncing off these levels very accurately. And the most important thing is that it shows opportunity. Okay, so in other words, as the market is going, there is a tremendous amount of opportunity to get in and out of trades and capture profit on a daily basis. If you go through this entire course, you watch all the videos, you attend the live trade room, you practice the trades, you followed everything as laid out in the getting started page, and you get to the point to where you really understand exactly what we're doing, I think every single one of you, as long as you follow that, would agree with me if I told you that you should be able to make money every single day, and not just a little bit of money, but a lot of money. And as I go through this video, I think you'll see that, and I think you'll see it very clearly. In fact, if you were even down for whatever reason, if you just keep following the rules and trading by the parameters that are set out, you not only should be able to pull yourself from being negative, but very positive. So there's a video on the university page, and this video is titled Trade Logic. So I'm going to cover some of those things here, and so some of this will be repetitive, but it's really important that you understand this. So I specifically want to talk about what a bounce is and what a pullback is. So if you go to the definition in the vocabulary page, we can see that a bounce is a move up in a downtrending market, and a pullback is a move down in an uptrending market. Now, I know this is basic, but this is really important that you understand this, and the reason why is because identifying this will help you understand what to do. This is one of the things that can help you understand what to do. Okay, so let me illustrate this. So if you look at this chart, this is just a chart I made up. It's just a series of candlesticks. And you could use bars, you could really use any kind of charting, but I'm just going to use candlesticks to illustrate a simplistic point. So each one of these candlesticks represents a time. It could be a 1 minute, 2 minute, 5 minute. So each one of these, let's just say it's a 5 minute chart. So during a 5 minute period, each one of these candles will form. So if we start all the way to the left, we can see that the next candle after the first one, its low is higher than the previous candle's low. And then if you go to the next one, we can see that this candle's low is higher than the previous candle's low. and the next one, same thing, and then the next one, same thing. And so when we talk about market logic, this is really a lot of what we're talking about. So if you go candle by candle, what is the market doing? Is it going up? Is it going down? Is it making a correction? What is it doing? Well, all you need to really do is just start at one point. Okay, and in some cases, it really doesn't matter what it's done. Let's just start right here and right now. And so we can clearly see that the market is starting to go up, or maybe it's been going up. Doesn't really matter what happened before this. We know that right now in real time, the market is going up, and we know that because each of these candles is setting progressively higher lows. Okay, so in order for us to continue, this next candle needs to continue on that path, right? Well, there's a little saying I learned many years ago that if something doesn't do what it's supposed to do, it might be a sign of something. And so what that means is that if in order for price to continue up, if this candle is supposed to be setting higher lows, then if it doesn't, it might be a sign that, hey, this might be pulling back. Okay, so that's where that term comes from. So the market's going to pull back. So anytime you see PB in the trade room, that's what we're talking about here, a pullback. Okay, so it might be pulling back. It could be temporary, and this is just, again, just an illustration. But what's going to confirm that is the next candle, right? So if this really is going to come back and pull back, then this next candle, it should be setting a lower low and ideally a lower high. And the reason why we want to look at a lower high is because if we're going to try to go up, then this high on this candle should be higher than the previous candle, right? So if we're going to continue in a direction, then we should be progressively setting higher highs and higher lows. Well, we didn't, and so this one had a lower high and a lower low, and so then the same thing repeats on the next one. So this next candle set a lower high and then a lower low, and then the fourth candle, as I have illustrated here, set a lower low and a lower high, and then we just go to the next one. So then the next one is approximately equal. I believe this was one tick higher, but the high breached the previous high. So remember, if something doesn't do what it's supposed to do, it might be a sign of something. Well, in this case, it broke this previous high. Now, does this mean we're going to go up? Not necessarily. But in the moment, real time right now, this is trying to go higher. So what's going to really be the tell-all is the next candle and the one after that and the one after that. So the next one, this candle's low is higher than the previous low, and its high is higher than the previous high. So okay, this is a really good indication that we're going to start to head up. And so this process repeats over and over and over again. So one of the things that you can do to look at as an overall trend is try to identify a series of candles. So in this case, I have several in each direction, and charts are going to be a little bit different than this, but I did it this way so that you really understand the concept. Okay, so if we have a series of candles in a direction, and we are progressively making higher highs and higher lows, or if we are progressively making lower lows and lower highs, this is a very obvious indication of what direction the market is headed in. Now, the second part to this is to identify peaks and valleys. Okay, so a peak, if we start at the left here, would be this high here, and you know you have a peak if we climb up and then we start to head down, that would be our peak. And then so the valley, and there's different terms for these, but I'm just going to use the word peak and valley to describe these highs and lows here. So this would be a peak, this would be a valley where this low is set, and then we climb higher. Now this third candle here in this new uptrend, or at least this temporary uptrend, is higher than this previous peak. So if we're looking at kind of a bigger picture, what has to happen? if the market really is going to head up, as we got an indication from this first candle, well, we really need to break this high at this peak, and not just break it, but continue. So then we look at the next candle. So then the next candle, this candle has a higher low and a higher high, and then the next one, and then the next one, which becomes our new peak. And we know it's a new peak because the next candle has a lower high and a lower low. And so here we have a pullback. So again, a pullback is a move down in an uptrending market. Okay, so we can see between this pullback and this pullback, the valley, or in other words, the low that was set at each of these, this second one is higher than the previous low. So we have individual candles that you can look at, and then we have the bigger picture, which is a series of candles, and there's no magic number. It could be 2, 3, 4, 5, 6, 7, 8, 9, 10, more, less. You just have a series of candles in a trending market, either up or down, and then you're just identifying this low, is it higher or lower than the previous low in the prior series of candles? Well, it's obviously higher. Okay, and then the pattern repeats itself until it doesn't. So if we fast forward a bit to the high of this illustration here, we can see we have a series of 7 candles that progressively set lower lows and lower highs. Now in reality, some of these candles might actually have higher highs, but what we're trying to identify is the progression, or in other words, the word we like to use is logic. What's logical? If this is a pullback and or a trend reversal, then we're going to look for lower lows and lower highs. Okay, so as we come down to the 7th candle here in this new downtrend, we're still looking for the same process. We're looking for lower lows and lower highs, right? Well, this next candle, it had a higher low and a higher high. The next one, the next one, the next one. These 5 candles all set higher lows and higher highs. So at this point, we continually look for that. What is the market doing? What is it trying to tell us? Well, it's trying to tell us that, at least right now, it's trying to go higher. But then we have this next candle, and it failed to go higher. So remember, if something doesn't do what it's supposed to do, it might be a sign of something. This one set a lower high and a lower low. Does it mean that we're going to head down? Not necessarily. We need to watch to see what happens. This very next candle sets a lower high and a lower low. Okay, this is pretty good confirmation that we are going to head down. And sure enough, we get a series of candles that are progressive, setting lower lows and lower highs, and the process just repeats itself over and over and over again. So what does this mean for us with what we do in the trade room? Well, it means a lot, because we have these price levels that are insanely accurate, and it gives us an opportunity to use that basic knowledge of logic to get in on numerous trades. So if we know that a pullback is for buying, so in other words, if a pullback is a move down in an uptrending market, then we are going to want to look for a price level to get in on there. So I have this line drawn in here, and let's just say it's one of our levels. So what would you do? Well, we would consider buying that. We know that we're in an uptrend. We're looking for pullbacks to buy, and that's where we get in. Now we can see here, when we had these 7 candles progressively going lower, we actually did breach this previous valley. So once that level has been breached, we're going to look for price to continue on down in that direction. Well, it didn't on this next candle. We started to head up again, but by the time we got to this high, at this peak after the high of what I have on display here, we have a clear direction that has been set by the progression of lower lows and lower highs. So now let's talk about bounces. And if we go to the definition, a bounce is a move up in a downtrending market. So what I've done is I've extended this chart to show the progression of this movement. So at the end of this series, we had a low that was breached with this low, breaking past this previous valley, and we set this high, which as we talked about is lower than the previous high. Okay, so now if we're looking at a broader picture, we're looking at a series of candles, and we can see that we've set a lower low, and now we have confirmation that we have set a lower high. So with this series of 7 candles, progressively setting lower lows and lower highs, this low has breached the previous low. And then so what would be logical? Well, what would be logical is that if we are going to continue in this trend, any type of what we call a bounce, wherever that peak is set, would need to be lower than this high. Now, sometimes you can get equal highs or roughly equal highs, and we're not talking about that at this point. The important thing is to just understand simple logic of market movement. And so the reason why we would want to sell a bounce is because as price is moving along and testing and retesting different levels, we want to take advantage of whatever trend the market is in. So we already know that whether we are in an uptrend or a downtrend, there's always going to be price fluctuation. And so this was our first bounce, and that was confirmed by the progression of this high that was set that was lower than this high. And we got that confirmation by these candles that progressively made lower lows. Once we broke this low, we had a bounce with these 5 candles here, and they made higher lows and higher highs. We peaked out at this line here, which you ideally already had an order in. And so if we're anticipating the market dropping, by following logic, we can place an order at this price level to short the market and then ride this down, and then the process just repeats. And so we just watch this, and this new low that was set was lower than this low. We have another bounce, it comes up to test this price level, we can short that, and then as we can see here, these remaining 6 candles are making lower lows and lower highs, continuing the trend. So back to the question, do I buy or do I sell? And I'm going to cover a couple more things here. If price is in the middle of any one of our levels here, let's just start at the very beginning. And we know that we are in a definite uptrend. What would you do? Well, the logical thing would be to buy any pullback. So if and when the market pulls back, then we're going to look to put on a trade at this level here. Now, if you shorted this up here, would that have worked? Yes, absolutely. And we could look at charts and we'll see the same thing. And so earlier when I said, well, you could do either or you could do both, you literally could do either or both. You see, what happens is a lot of traders become fearful of getting into the market because obviously nobody likes to lose money. I remember not too long ago, a good friend of mine told me a story about a really good trader who had his son put on a $100,000 trade, and he said, click buy. And so he clicked buy, and then after he clicked buy, he realized how much money was in the market, and he was freaking out. He didn't know what to do. He said, okay, so we're in the market, and now your job as a trader is to get out of the market. Now, obviously the objective is to make money, so we're in the market and we're going to look for ways to make money. How can we do that? And if it's not presenting itself, then what we're going to do is look for ways to cut our losses and get out and then look for the next trade. One of the exercises that sometimes I'll have traders do on a simulation account, mind you, if you choose to do this, is just to open up your charts and literally click buy or sell. But preferably do it at one of these levels because these are going to give you the best opportunity to either make money, break even, or take a small loss. So if you're at the opening candle at this, on this screenshot, the obvious thing to do is buy. We're right at a price level, and so we're going to want to buy that. Could you sell it? Of course you could. But if this is going to be, let's just hypothetically say this is going to be support, then the obvious thing to do is to buy. And if we're just kind of in the middle here, then place a sell order up at this first line here. So then your job as a trader is to get out of the trade, preferably with profit. Well, how are you going to do that? Well, you're going to watch the candles, and you're going to watch the progression, and at the same time though, you're going to place your exit for profit. So the next logical place to do that is this next level down here. Now if this next candle is not working out, then typically on a 2-minute chart, or if you use a 5-minute chart, in most cases you have anywhere between 2 to, I think today we saw up to 10 minutes to get out of a trade at break even or even a small profit. So if trades are not working out, there's no reason to fight it. There's no reason to be married to that trade. It's important that you're not concerned about a single trade so much as you are concerned about the next 1,000 trades. So now let's go to charts, but before we do that, I want to pull up this video one more time and just have you look at this for a second, because the other thing that this illustrates, and I actually created this about 8 years ago, this is actually a really old illustration, is it shows a reaction to something that in 2007 I called prediction points. And some of you, we don't use that word too much. Some of you know, and some of you don't know, that the price levels that we're using in the room every day are called prediction points. And I'm not going to get into the story about how I created them. It's actually a pretty cool story, but the end result is these price levels that we use, that if you've been around for any amount of time, they're insanely accurate. So back in 2007, when I created these, I actually originally created them for the Russell 2000. Back then it was traded on the CME, then it got sold to the ICE, the Intercontinental Exchange, and then recently it was sold back to the Chicago Mercantile Exchange, the CME. Not that that has anything to do with anything, but I had these price levels that I had no idea how to use them. I knew that they were incredibly accurate in a very uncanny way every single day. It didn't matter if it was the real estate crash of 2008. It didn't matter if it was dead markets, just sideways markets. Every single day, the market reacted to them on an intraday level. So literally, one day I decided, you know what, I'm just going to buy and sell off of them and then figure it out. So this was about, this was 2007. And so I did that on the Russell. $10 per point, or excuse me, $10 per tick. There's 10 ticks per point. So you're $100 per point. And so if you're trading on margin, at the time I think my contract size was $500. Every 10 points you made 100% on your contract. $500. So my first week, I didn't trade all day. I just traded for anywhere between 1 to 3 hours a day, roughly. And I was up over 33 points, something like that, my first week. And it was insane. I couldn't believe it. I was literally just buying and selling. I didn't know what to do, because I had these lines and I did not know exactly how. I had to create a way to do it. And it was unbelievable. So we fast forward to today, and that whole process has been refined to a point to where you literally can pull out dozens and dozens of points in the first 1 to 2 hours of the day. And in a second here, I'm going to show you, we're going to go to charts. I'm going to show you some things on charts that are really important that you understand. And I think you'll see the magnitude of what they provide on an entire daily basis. So let's go ahead and head over to charts. Okay, so here we have the ES. This particular day is March 29th, 2018. And so this is the entire day. This is the opening candle all the way to the left to the closing candle of the extended hours. That's why that's grayed out right there. So at the start of every day, you're given kind of a plethora of numbers, right? Well, what I want to talk to you about here is something to really help you not be so overwhelmed by the amount of price levels that you have. And so I'm going to show you a couple things that should help you understand these maybe more in a different light. And my hope is that by the time we're done with this, you'll see really how powerful these price levels are. So in the vocabulary section of the site, we have each of the 3 price levels described on this page. And so we have the CPAs, which are the critical price area. And as it says here, this could be a single price or a cluster of prices. These are our longer term targets. We essentially expect the market to move from one CPA area to the next. So what I want to do is I want to show you only CPAs on this day. We could go really through any day, and it really didn't matter. I just happened to pick this day. So I'm going to put up only CPAs. And so on this day, these were all of the CPA price levels in the range from the high and the low. There was obviously some above, some below, but from the low of the day to the high of the day, these are all the ones that were within the trading range for the entire day. Okay, so if you know that these are longer term targets, and if you know that the expectation is from the market to move from one to the next, how do you think that would help? Well, for me, that's tremendous insight, because if I am looking for, where is price going? What is it doing? Do I buy or do I sell? And if I apply what we just talked about higher lows and higher highs, and just following simple logic, if I'm long in a position, then I'm going to target the next area. And remember, if something doesn't do what it's supposed to do, it might be a sign of something. So if it fails to do that, fails to continue in that direction, kind of like it did here at open, then hey, that's all right. It might be a sign that we're going to head the other direction. Does that mean I panic out of the market or start to freak out and then don't make any trades anymore? No. What that means is it gives me more opportunity to get in on the other side. So then let's take a look at KPs. And on this site, KPs, of course, are key prices. And these will be important for the current trading day as interim price levels depending on momentum. So, by the way, it doesn't matter what trading software you use. This particular one, I'm using TD Ameritrade. Just have an account there I manage. A lot of people use NinjaTrader, Sierra Chart. I mean, you really can use any charting software that you want. So just because I'm using this, I just want to make sure that you understand it. It really doesn't matter what you use. So I'm going to pull up the KPs. And so on this day, these 4 price levels were the KPs that fell within the range of the high and low of the entire session. Okay, and so these levels, remember, they're going to be important for this day, and they're going to be important if we have momentum. So in other words, similarly to the CPAs, but different, if the market can gain momentum, we're going to look for really price to reach these levels. Okay, and sure enough it did. On this lower end here, we didn't quite make it down. I don't remember where the next one below us was, but it wasn't even on the screen. So we just had failure down there. Failure just meaning it didn't continue down. Okay, and so this is CPAs. And so what I'm trying to do here is just help you see things a little bit less cluttered. And then what I'll do in a second here, we're going to go over IPs, and then I'll bring in all the lines, and then we'll kind of break it down a little bit. We're not going to do a day review, but I want to help you understand a couple of key components at why all of these lines matter. And really quickly on the site, IPs are important prices. These are likely places for TSP and re-entering. Okay, and so as you can see, these were very important for that day. And there's a tremendous amount of trades if you look at it from this perspective. So as traders, regardless of what discipline you practice, we're all looking for trading opportunities. We're looking to get into the market and make money. And so there's something that we have that's on our side, and that's these price levels. These price levels, as you can see, are insanely accurate. The market is using every single one of them, and in a lot of cases it's having a direct response to as we are changing trend or as we are confirming the direction. And so if you combine price levels this accurate and you add in simple logic and you just get into the market, put the trades on where you're supposed to, take them off where you're supposed to. So let me pause right there and just explain what that means. You know, the question I would imagine would be, what do you mean when you say put the trade on and take them off where you're supposed to? Well, if I'm going to use these price levels to get into the market, then it would make sense that I'm supposed to put on a short position either here and or here, right? So if price opened here kind of in the middle, we have prices above and prices below, then if it's going to come down, I'm going to look to potentially buy off of one of these areas down here or short one of these areas up here. Because what I have in my favor is I already know since 2007, every single day, these have an insanely high probability of the market reacting to these prices. Then I already have the odds in my favor. It doesn't mean I'm going to win every single trade, but I've already eliminated an aspect of improbability. Does that make sense? So I'm using probability in my favor to gain an edge over market movement. Now, as accurate as these IPs are, there's a lot of movement in here that we're simply not capturing because we don't have price levels there. So if we look at, like, for example, this middle section here, and although the room is not open during this time, we have about 2 hours where we have no trades other than taking this short that on every single one of these pullbacks, they don't make it to the next IP. Well, if you're a trader, you're looking for opportunity, and so what we do is we implore all of these different price levels in such a way that there's always opportunity to get into the market. And as you can see, you should realize right now that these are not random price levels. This is something that is calculated every single day. I've been doing it ever since 2007. I don't think I've missed more than a total of a week in all that time. And they do this every single day. So if I bring in all the other levels, when you first look at this, it looks like kind of a mess, right? It's just, there's a lot of price levels here, and it's just, I can see how it would be really confusing. But if you know that CPAs, we expect the market to trade between, and if you know that if we have momentum, that the KPs are most likely going to get hit, and as the market's developing, we have our IPs to take some profit or even to re-enter positions at. Now, I will pause and say that, can you re-enter positions on a CPA or a KP? And of course the answer is yes. So when you are learning these definitions, it's important that I stress that this is the general guidelines of how these price levels work. It doesn't mean that you cannot do the same thing off of other price levels. What it means is that the distinction between these three different price levels, their properties have these habitual patterns. Okay, does that make sense? It means that on a day-to-day basis, over and over and over again, this is usually what each of these price levels do. So we'll go from one blue single line or cluster. Remember that CPAs can either be a single line or a cluster. So when we have a cluster here, you know, sometimes what I like to do is put a, kind of just imagine this, you know, big rectangular box around that area. So I know that this is an area, you know, rather than just an absolute price, because there's, you know, they're kind of congested between here. This is an area that we're gonna really have to fight through to either get back below or continue up above. So you have the blue levels, which are the CPAs, which I actually have labeled here, that you know, where you have the expectation for the market to trade between from one to the next. If we have succession, meaning if price stays above this level, and in this middle cluster here, we never came back below it. We have a lot of buying opportunity to get in on these trades here. I mean, I'd have to sit and figure it out. There's so many trades in here. And so once we breach that, where are we looking to? Well, we're looking to the next blue area. In other words, the next CPA single price or cluster. And it's exactly what happened later on in the day. We got to the next one. So if you take a step back and you look at things from a larger or broader perspective, this should give you a much clearer idea of what to do. So when the question arises in your mind, should I buy or should I sell? Really, honestly, the answer is either. Do either. Just get into a trade and then manage the trade based upon different levels. If the trade's not working out, take it off and then go to the next one. Never be wrapped up in a single trade. Always look to the next trade and then the next trade. Now, that doesn't mean that you ignore the trade that you're in, because it's important to manage that trade properly. But what I'm saying is that it's important not to get so caught up in a trade that you all of a sudden become emotional. Okay, the market doesn't care if you are in a trade or not in a trade. It's gonna move anyways. So there's one thing that I also want to point out here as well, because it's staring at me in the face. That is somewhat off topic, but I want to point it out anyways, because this is something that I think is really important that you take note of. So this is something that happens quite frequently, and what that is anytime that we break an orange line and we have a green line right beyond it, it almost always has a very strong reaction. It doesn't mean it's a trend reversal by any means. It just means that it's going to have a pretty good reaction. So if we look at this very first one, the opening candle, we broke the orange line and went to the tick of the green line, and as you can see, it nailed it, and we made it all the way back through to the next green level, our IPs, and 2 ticks away from that low CPA at 2608.5. So if we look at the next time that happened, we can see that this orange line was broken and it had a beautiful reaction on that very next green line. If we go to the next one, this orange line was broken. I'm not going to count this one because they're just a tick apart, even though it technically did work. But this one, it broke it, got to the next green line, had a beautiful reaction. It attempted here. This is a type of situation where we got a point span between them, and you got plenty of time to get that trade off. It's obviously not working out. Okay, this is a 2-minute chart, one of the ones we frequently use, and you can get that trade off. Okay, so I want to point that out because as you are in the room and you're looking for different opportunities, obviously there's always an opportunity to always be in the market. But this is the type of scenario that works really well. So what I'm going to do here is actually just highlight the trade room. So what we're looking at here is the time that the trade room was open, and I believe this day was over 30 points or so that we figured, getting in on these different trades. So it's really important that you understand that if you look at these price levels more as individual blocks, you have your blue blocks or clusters of prices, you have your green ones, and then you have your orange ones, and they all have a purpose. And really, if you boil it down, the purpose is to give us opportunity to get in the market and make money. But if you're following logic, you're following, what is the market doing, then there really should be no question about whether you should be buying or selling. If we look at this opening candle, we're at our blue cluster. So just look at this as kind of this cluster, and you ask the question, well, should I buy or should I sell? Well, we're at this CPA, and we know that we expect price to trade to the next one, but we also have these 2 IPs and this 1 KP, and if we know that IPs are for taking profit, we have 2 opportunities to take profit on this trade. One of them goes to the tick, and we didn't have any follow through on this next candle. So this high was lower than this high. So we have this high that was lower than this high. And yes, this low was higher than this low, but if we look at the next candle, this low was actually equal and this high was lower. Same type of thing on the next one, equal highs but lower low. And so okay, this is not getting the follow through. So at this point you're still positive, and remember, if something's not doing what it's supposed to be doing, then it might be a sign that, hey, we're going to be heading the other direction. So winning trade whether you went long or short. And so that's why in the room, we don't know if you bought or if you sold. If you follow logic and you are reacting off of these price levels, some traders in the room are long, some traders in the room are short, and honestly some are both. We won't talk about that here, trading two accounts, but some are literally both. They're in on two different accounts. They're in long, one's in short, and both accounts are making money. Okay, so both the long position made money and the short position made money. Now the short position ultimately made more money because we failed to continue higher to the next CPA, but didn't really matter which direction you chose, long or short. So back to what I said earlier, put the trades on where you're supposed to put them on, take them off where you're supposed to take them off. We already know where we're going to do that before the market even starts. So if we followed every single candle, which I'm not going to do, you should have a really clear idea about what to do at any given point in time. Whether that be taking profit, whether that be breaking even or attempting to break even or cutting a loss. So if you bought at this lower CPA, it actually went for 3.5 points. And we failed to have the follow through. And so if you didn't completely get out of that trade, then this gave you a pretty good indication. This one came back a tick below it, and you should have been able to take a small loss on that. But it's a really good indication that this is just, it's not going to go up. Okay? What's important to do is to get in the habit of getting in the market. Don't be fearful of getting in the market and putting a trade on. Our job as traders is to put the trades on where we're supposed to and take them off where we're supposed to. So if you look at this entire day, now with hopefully this new light shed on what we're doing here, you can see that you literally could trade this all day long if you really wanted to. And I don't know, it would take me a while to figure it out, but the room, there was over 30 points available in the about an hour and a half that we were there. So for the entire rest of the day, I don't know, it's well over 100 points. But you can see that if you just put the trades on, take them off, it's either working or it's not working. And hopefully you understood the ideas that I gave you on how to determine if it is working or not working. And you almost always, unless the market is just blasting up or blasting down, you in most cases there's usually ample time to take a losing trade off at break even, and sometimes even getting a few ticks profit, or worst case scenario, losing a few ticks. But those trades are passed, and then you just go to the next one, and then the next one, and then the next one, and then the next one. And it's just a repetitive process. So we literally are doing the same thing every single day. So every time you come to the room, it's not a new market. The only thing that's new is where the market is trading at. This day it was trading between the low 600s to almost 660. The next day was a different price range. The next day was a different price range. And because we have the advantage of having highly reactive price levels, this gives us so much opportunity every single day to repeat the same process over and over and over and over again. So you go from initially thinking, wow, that looks like a mess, that just looks like a bunch of arbitrary lines that mean absolutely nothing. But when you break it down and you understand exactly what's happening, you go from that to, wow, look at all that money. So this is a game of repetition. Remember, repetition is the mother of skill, as the saying goes. And so the more you repeat this process, the better you get, the easier it is to see these things. And of course, the end result is the more money you make. And the great thing about this is we can do it every single day, and it really doesn't matter what the market's doing. So this ended up being a long video, and I knew it would be, but every single component here is very important that you understand, because too often traders will complicate things, and there's no reason to complicate this. We have these accurate price levels. It's exactly where we're putting the trades on. It's exactly where we're taking the trades off. We've distinguished these price levels by 3 key areas between CPAs, KPs, and IPs. They each have a purpose. Each of them give us opportunity to get in and out of the market. And if you use them that way, you'll just be unstoppable. So remember, if you have any questions, shoot us an email, and we'll see you in the trade room.